Hello, this is Rusty and Ricky with Real Texas Capital. Hey, thanks for joining our conversation today. We're here to talk today about the different ways you might be able to capitalize your project, whether that be using your own funds, which is always an option if you have the cash capability to do that or capacity. Certainly, more traditionally using a bank, or thirdly, which you may not have had experience with, is using hard money or often referred to as private money. We'll explain what that is and go through the advantages and disadvantages of each. So as far as bringing your own cash, really that's probably the easiest and simplest, but it's the hardest to accomplish because most people don't have the cash available to use their own money, or if they do, they're limited in their capacity, so they can only do maybe one project at a time. So that's we'll move on then to the difference between private lending, hard money lending versus bank financing. So I'm going to kind of go over some of the advantages that I think are specific to a private money lender. And I think probably the number one thing is the fast decision making and the very fast closing time. So typically a private lender can make a decision probably within 24 to 48 hours and then subsequently fund it maybe within a 48-hour period as well. But usually you want to allow for about 2 weeks. But regardless, it's still a very fast process when compared to the bank. Flexibility would be another advantage. Private lenders aren't as concerned about all the red tape that you would normally experience at a bank. You know, we want to go ahead and look at the asset itself, and about 75% of our decisions can be based upon the asset and the rehab project, and about 25% is going to be based upon the borrower and their ability to perform credit and cash capacity. It is truly asset-based lending based upon what I just told you there, that 75% of the decision making is on the asset itself. We want to be able to protect ourselves if the loan goes bad, heaven forbid, and make sure that we're not making too risky of a loan. We also look at the experience of the borrower, and we certainly do work with new borrowers. We're not going to disqualify you if you're new. We just might require you to bring a little bit more cash to the table. As far as the approval process, we typically have a higher approval process than most banks because we're not looking at debt to income ratio. We're not looking at your W-2. We're basically looking at the project itself, and we want to make sure that there's a likelihood that the borrower is going to be able to exit the project with a profit, and we want to make sure that the borrower has the capacity, both from a cash standpoint and the just ability to take the project down. So those are some of the advantages I see. Rick, why don't we flip the switch there to you, Rick, and talk a little bit about bank financing and what you see the advantages are there.
Yeah, thanks. So, typical traditional banking, large banks, even regional banks, even local banks, they all are regulated. And so sometimes it takes a little longer, as you had mentioned, to get a loan funded. And oftentimes a bank will really rely on the creditworthiness of the borrower. They check their income status, their employment status, their credit history, and a lot of that has a big play into the decision making for a bank, whether or not they would, approve you for a loan or not. The good thing about a bank, though, is they typically charge less interest rates than a private money lender would, and their long terms are a little bit more flexible in terms of longevity. They will go a little bit longer than a normal private money lender or hard money lender, and the banks typically take a little longer, like I mentioned before, because they're relying on third parties to do surveys, and they require surveys, and they require third-party independent appraisals. Whereas, a private money lender, they can make their own judgment, ascertain what they truly believe the value of the asset is without relying on third parties. They can rely on third parties, but they're not required to do so. It's not a regulation that they go out to third parties and verify the asset cost. But loan denials are probably a little higher with the banks because they do rely on checking on the borrower's capacity, their payment credit worthiness, their payment histories on other loans. And when you contrast that to a private money lender, they're like you said, Rusty, they're more concerned about the asset itself and what's the value of the asset. So sometimes too, that banks, because they require these extra hoops to go through and have extra regulations, they can also incur more closing costs for our borrowers. So heavier regulation, they have limited flexibility, slower closing times, and higher denial rates. But for that, if you do get through those hurdles, you do get sometimes a longer period loan for a lower interest rate. And so if you're in this market of fix and flip or rehab projects, speed and flexibility, or if that's something you're trying to accomplish, it's usually advantageous to at least explore private money lender route versus going to a bank.
Yeah, I mean, typically that's where you're gonna the deals are buying at a discount are typically won when a quick closing can occur, and banks just can't perform that quickly. They're not designed to close that quickly. They're certainly more designed for larger commercial projects, or certainly just a homeowner occupied residence. But one of the things that is worth mentioning with the private hard money loans, yes, you're going to pay a higher interest rate. Obviously, that's a disadvantage. Yes, the origination points are probably going to be a little bit higher as well. But keep in mind, you're typically only going to have a loan out for the duration of your project. So that may be 6 months, 9 months, maybe a max of a year before you either flip that property or you refinance the private money lender out in lieu of a more permanent financing with like a DSCR loan. So even though the interest rate's higher, you're not going to be holding that loan for very long. So it's really not going to make that significant of a difference. So
yeah, and I'd also just like to add to that, if I was a borrower, I'd like to pick up the phone and contact the person who's actually loaning me the money and see, have a conversation with the decision makers. And in cases like us, where you and I are a boutique private money lender firm, you and I make the decisions and whether or not to fund a project, and we try our darndest to make sure that we get decisions made quickly for our borrowers, whether that's yes and the conditions in which we would fund, or a quick no is oftentimes just as advantageous to our borrowers to know, okay, you will or won't loan. And sometimes that decision-making process with the bank, just getting them to make a decision, can take a while. And quick decisions and talking with the decision makers themselves oftentimes behooves somebody who's needing to borrow money for a quick rehab project. And I know you and I take great pride in trying to be very communicative with our borrowers, making quick decisions, being reasonable, and reducing the red tape, really.
Yeah. Well, hey guys, if you got a project that's needing funding, we'd love to talk to you about it. If it's here in the Texas market, you can go to our website at rtx.capital, or and our phone numbers are on there. Give us a call. We may or may not be able to fund it, but we're gonna have some conversation with you, and hopefully provide some advice and lead you in the right direction. So thanks for joining our conversation today, Rick. Appreciate your feedback.
Appreciate you. Thank you for listening.